In his book, How to Make Money in Stocks, IBD founder Bill O'Neill wrote mutual funds are outstanding investment vehicles if you learn to use them correctly. And here to help us learn all about mutual funds and how they can help you achieve your financial goals is IBD's very own personal finance and management editor, Matt Krantz. So Matt, tell us, what are mutual funds and why should you consider them as an investment vehicle?
Yeah, great. So mutual funds are basically simplified, a pool of money from investors given to a manager entrusted to put those assets to work, usually investing in bonds or in stocks. They usually come in two varieties. They're active or indexed. Active means you're giving it to a human or a team of humans who you think are smart enough or skilled enough to find winning investments with your money. And in index mutual funds are those that are automatically tied to an index, such as the S&P 500, and they're really designed just to match that index's performance.
And how can investors make money in mutual funds?
Yeah, so ironically, the best way to make money in mutual funds is to not think about them that much. So I think Bill O'Neill used to talk about buy and forget them. So you pick a mutual fund you think is going to be good, you put your money in there and you just let it kind of ride. You check your statements, but you don't make like minute changes in your investment portfolio. You just kind of let it go. And you kind of trust that either the index you picked or the people you picked will do a great job long term.
Well, it's all about harnessing that power of compound interest. And tell us a little bit about when is the best time to buy a mutual fund and how many should you own?
Yeah, and I'm so glad you brought up compound interest. That's the key to these things is you start with a snowball at the top of a mountain and you just let it roll down and just you'll be shocked in 20 years how big it can get because it just kind of grows and grows and grows and grows. So really the best time to buy a mutual fund is either 10 years ago or today. So basically, sure, I mean, if you bought it 10 years ago, that'd be great because you'd be up so much. But if you didn't start, that shouldn't be a reason to not start. So it's best to just kind of get going. And usually when people do mutual funds is when they have retirement accounts. So if you start a new job and you open a 401k or you open up an IRA, that's really where most people, get exposed to mutual funds.
And what are some of the common mistakes investors make when buying mutual funds and how can they avoid them?
That's another great question. So two key mistakes that are often made is one, they don't pay attention to the fees. You can actually buy really expensive mutual funds and you don't even know they're charging you this money. They can charge 2 or 3% a year. And if you end up paying that kind of money, it really eats into your performance. The other problem is you don't check the long-term performance. Some people just buy them. And I know we talked about you should buy them and forget them, but you should check in on them. And if they're not performing over like a 2, 3, 4, 5 year period, it's time to ask questions and maybe decide if that mutual fund's not doing what you thought it was going to do.
Speaking of performance, since there are so many options out there for investors now, how do mutual funds stack up against vehicles like ETFs?
Oh, you're totally right. There's over 7,000 mutual funds, and it's really hard to choose between them. And you're really making a bet on either the index or the human being running them. If you like human beings running them, there's more choice in the mutual fund space. So you can find teams of people with experience running money, and they get to have these niches and specialties like small cap or growth or things like that. But ETFs are really coming on strong. They have a lot of great advantages. They usually are tied to indexes, which is usually better because usually the indexes outperform the humans anyway. The fees are super low and you can buy and sell during the day and you can manage all your accounts right from your brokerage account. So ETFs are really taking over because they have so many of these key advantages.
And what are some of the things people should consider on how to handle mutual funds versus ETFs, especially, if you have limited options through your plan administrator or through your account?
And that's a key point. So most people will buy the mutual funds they have to buy. So most people buy them through their 401ks or their IRAs. And like you point out, they don't really have that many choices. The one thing I would definitely caution people is I think a lot of people default to the target date choice. So what happens is a lot of 401ks will cobble together a collection of mutual funds that they think are the best. But if you really dig into these, they're actually amalgamated groups of funds. So it's like a bunch, they pick the funds that you're going to own. And a lot of times the fees can be higher and the returns may be lower. So in a lot of times, and in many cases, you're better off just picking the index fund out of the choices. So if you have a lot of bad active funds to choose from, you're probably better off just buying the index fund and calling it a day.
Well, Matt, thank you so much for your insights today. We really appreciate it.
Thanks for having me.